So foreclosure activity doesn't affect market reality, and we've got some more changes to forbearance and the eviction and moratorium. Foreclosure moratorium is going on. Welcome to Housing Bubble 2.0 News of the Week, or as I like to call it, another episode of As the Housing Market Turns. Randy Patrick here, putting the realism back in real estate news. Today is the 15th of February. We're basically just halfway through the month, I guess you could say. Hope everyone had a great Valentine's Day and it was successful for whatever you did yesterday. We're going to get into it right now. Lots going on, lots to talk about. I haven't been doing a video for a week, so got to catch up. But first of all, if you're not already a subscriber, if you could do me a great favor and smash that subscribe button, help my channel grow, I'd really appreciate that. So thank you very much. Today's video is brought to you by Foreclosure.com. I've arranged a partnership with Foreclosure.com. And why? Because they're like the leading, distressed property data provider in the U.S. And if you'd like, go to gethousingdata.com, grab your 7-day free trial. Why do I like it? Because it's cost-effective, reliable, accurate data, under $40 per month, and you can take a look at the stuff that I'm talking about on basically every video. So it doesn't cost you much money to go in and look at the data, see what's going on in your local market, to look at the opportunities. GetHousingData.com. We'll see you there. All right. So guess what? I'm also going to do a State of the Nation. I haven't done a presentation, an offline presentation, for quite some time. There's so much on the go, so many things I'd like to talk about as to where the market is headed this year and what to expect and how to play around it. Housing Bubble 2.0, State of the Nation. I'm going to do a presentation. I do it on the Facebook Live platform. Now listen, I know what you're going to say. I don't do Facebook. Well, you know what? Everybody's got a Facebook account, all right? And you know what? I don't particularly like Facebook anymore as well. But guess what? It's one of the more secure ways for me to do a presentation like this. Also, my discussions are usually 90 minutes to 2 hours. Something I don't want to do on YouTube. A little better control for when I do this myself in the evening time. So it's this Thursday, Feb 18th, 8 p.m. Eastern Time, 5 p.m. PST. I can't do it any later, guys, because guess what? I'll be falling asleep. All right. Facebook Live at Housing Bubble 2. Just type in Housing Bubble 2. You'll see that's our page. Basically like or subscribe to the page, follow the page, and you'll see it go live. So people will say, when's it going to happen? Once I go live, you'll get a notification that's happening. You can jump on and watch it right there. It's interactive too, because what I can also do is I can see your questions and I can sort of work with everybody as I'm doing the presentation. So that's this Thursday, State of the Nation for the housing industry. All right. So January's foreclosure activity does not reflect market reality. This is out of National Mortgage News here. And foreclosures hit an all-time low in January as President Biden's extension of the foreclosure moratorium spared millions of delinquent borrowers from entering the process, according to Adam Data Solutions. After rising 8% in December from November, mortgage foreclosures dropped 11% month over month in January and dropped 80% from a year earlier, according to Adam. Foreclosure filings, inclusive of default notices, bank repos, and scheduled auctions, dropped big time. So the total 9,700, which was down from just over 49,000, a year ago in January. So that's a pretty big, that's 80% right there. January foreclosure activity declined, at least in part due to the Biden administration's decision to continue the foreclosure moratorium on government-backed loans through the end of March, said the EVP of Adam. But it is important to remember that the number of foreclosures we're seeing right now doesn't reflect market reality, and that's something we'll need to deal with once these government programs expire. So yes, it's time we all start realizing that we're in what I call like the Twilight Zone, right? High, low interest rates, low inventory, high prices, all the distressed properties not moving. We're in this Twilight Zone, this kind of like suspended animation. You're cryogenically frozen. I don't know what you want to call it, but the whole point is not much happens with what's going on right now. So you're going to see some information here. So it's almost like, we're seeing locations having huge annual drops in foreclosure starts. So Chicago, New York, LA, Dallas, Houston. So why are these such big percentages and drops? Well, because these are locations that normally crank out lots of foreclosure starts and foreclosure activity on a normal monthly basis. So when there's only a little bit going on, they're going to show the biggest percentages here. So that's really what it boils down to. So, foreclosure starts fell year over year, 87% in Chicago, 85% in New York, 80% LA, 70% in Dallas, and 69% in Houston. Normally the numbers would be much higher, all right? So But we also see, though, is that when we're going to see, like, so some states are slowing down for various reasons, which I can get into in a second, but some states actually jump. So Washington jumped 63%, Virginia 54%, North Carolina 32%, Massachusetts 21%, 10% in Ohio. So it's one of those things where it's all relative. So if the previous months foreclosure filings or activities were low because of moratoriums and court systems and the way the state is structured with it, the way it handles its foreclosure process, then when there is some increase, it's going to look big. So same thing, the drops look big and the increases look big relative to what goes on in that state. All right, so don't think that the market's good. The market's just in a basic stall right now. That's what's happening. So that's why we're going to see Chicago, New York, LA, Dallas, Houston have the largest annual drops in foreclosure starts. And quite frankly, when we're taking a look at January, it's one of those things where a lot of it's up to the lender. Are they going to file? Can they file? Will the attorneys file? What will the courts accept it? How is the court process working these days due to the pandemic and a lot of the government office closings and things like that? So everything comes into effect when looking at these numbers. So as far as I'm concerned, it's news to report, but the news has an asterisk on it. It's not really reflective of what should be happening in the marketplace. So basically, at some point there's going to have to be a reality check recognition about what's the longer term economic circumstances of those families who are, facing who are sort of, I guess, protected by the moratoriums. Even for a family that's had a permanent change and can't afford their mortgage anymore, if we can't do a loan modification, we've learned a lot of tools to help create graceful exits and help to create a more stable transition. Nobody wants to foreclose on those families. So yeah, there's going to be loan modifications. There's going to be short sales. There's going to be discount buys. So it's one of those things that, there will be opportunity coming up. It's just a matter of when we're going to get there. Stuff's happening now, but the majority right now is not sort of working through. So this is Adam Data Solution. Basically, was their January report. That's where all these articles are based on. So really, highest foreclosure rates in Delaware, Louisiana, and Florida. So basically, we're talking filings. Delaware, and they look at rates as foreclosure filings per housing unit. So Delaware happened to lead the filings for this month of January, followed by Louisiana, Indiana, Alabama, Florida in there at number 3 as well too. And then we take a look at the highest foreclosure rates of we'll call it metro areas: Lake Charles, Louisiana, Birmingham, Alabama, Lafayette, Louisiana, Provo, Utah, Beaumont, Texas. So again, I look at Provo, Utah being expensive and not having much of this problem. But for example, when we take a look at relatively speaking, how many we're going on the month before, as to maybe in January you had some new activity, then that's why you're going to see a little pickup here. Basically, other than Birmingham, among the metros with a population base greater than 1 million, the worst foreclosure rates in the area included for January: Jacksonville, Florida, right here in Florida, Cleveland, Ohio, Miami, Florida, and Louisville, Kentucky. So we're seeing a lot of the normal locations, which I call the Floridas, the Ohios, Alabamas of the world, Illinois. Like, you're going to see Louisiana. You're going to see those locations kind of always be in the mix. And then you're going to see other various cities and various states pop up here and there based on, maybe some new activity or some catch up, etc. It's the way it goes with respect to the data for foreclosures. Once again, if you go to gethousingdata.com, you can actually drill down and take a look at what's happening in your local market and figure this stuff out, because that's where the information is. That's where the best deals are. Foreclosure starts increase monthly in 17 states. So we're seeing that right now. Counter to the national trend, which is lack thereof foreclosures. We saw, as I mentioned earlier, Washington, Virginia, North Carolina, Massachusetts, Ohio up with respect to increase in foreclosure filings. Now, we also, what Adam does is they take a look at populated counties with foreclosure starts in the rise. So really, I'll just get to the graph here because this is what we're going to see. So, for me, it's all about, okay, what county opened up. Maybe there's a backlog. It's time to file. So, for example, you had most populated U.S. counties with foreclosure starts on the rise in January 2021. Suwannee County, Florida; Boyd County, Kentucky; Berry County, Missouri; Butler County, Missouri; Callaway County, Missouri; Steuben County, New York; Jackson County, Oklahoma; Cameron County, Texas; looks like Coryell County, Texas; and looks like I can't really pronounce it. It looks like Yavapai County, Arizona. So these are counties that I guess you say are kind of random counties, but for whatever reason, they had a spike in their foreclosure filings. Again, it could be catch-up, it could be the government officer opening, it could be local attorneys, it could be a lot of reasons, but interesting to see that it's not just always in the big areas you're going to see a spike in this activity. And this goes to show that, foreclosures and forbearance, people not paying their mortgage, and issues are not just in the big cities and the urban areas. It's rampant throughout the entire country, and we'll see that manifest as the months go on. So just keep that in mind. All right, so if we move forward here, so what's going to foreclosure? So if you're saying, well, what is happening for foreclosures here? What's going to foreclosure if we have eviction moratoriums and foreclosure moratoriums? Well, the moratoriums are pretty much based on FHFA, government-backed mortgages, what FHFA is saying, you can't foreclose on. So we're seeing conventional mortgages, probably some non-banks that are going through. But what we're also seeing is that, the moratoriums don't apply to what they call vacant, abandoned, or zombie property. So this example was from the fall, in October, end of October, again from Adam. It just shows that, out of all the foreclosures that were happening in, for example, these 5 states as the top states for zombie foreclosures back a few months ago, Iowa, Kentucky, Missouri, Georgia, and Maryland, that a higher than normal percentage were zombie foreclosures. So basically, why keep a property that's unoccupied and derelict and falling into disrepair, and the usual, as we say, these zombie foreclosures, add a blight to the neighborhood, bring property values down, increase squatters, bring property values down, as I said, cause vandalism, pest issues, the whole bit. So that's what's going to foreclosure. So we're seeing that a lot of abandoned homes are making its way through foreclosure, thus the opportunity to get into this. So, and what I mean by that, you don't have to buy these at the auction. You can get them before the auction. And what I've done is I've realized this is a great opportunity right now. So I'm announcing this right now. I'm in the process of literally working on it. It'll be probably ready within a week. And I'll offer some great prices on this. But what I'm doing, let me go back a slide here. I just jumped that too quickly. So with the advent of, I have a program called Zombie Foreclosure Flip. So if this is something you're interested in and learning about, taking a look at these distressed properties, what to do with them, how to get your hands on them, etc., give me a shout, because I'm actually launching this. I'm working on it this week. I've got everything scoped out. I've basically been running like a fiend to this new program, this new course, and we'll be off. I can probably do some decent pricing, in advance of the formal launch. But the whole point is that this is what's going on right now. And what I want to let you know is that people go, well, I can't buy at the auction. Well, you know what? You use the data and you look at what's going to auction, but the whole point is that you get in touch with the homeowners prior to auction is where you cut deals. Because, the average person, the average investor doesn't have enough money to buy at the auction that's handy and sitting around in cash. The average primary home buyer doesn't have the, can't buy at the auction, a couple $100,000 cash. I get it. But what we can do is we can work with these homeowners if you can get a hold of them. And there's a whole methodology that goes along with it. But the point is, this is the most realistic opportunity to get your hands on a better priced property. And by the way, stick around towards the end of the video, because I'm going to show you some analysis as to why these properties are indeed cheaper than retail properties. All right. So not everyone looks like that, by the way. Okay. So anyway, going forward here, FHFA extends the foreclosure moratorium or forbearance period. And so that's kind of been the news. So we're looking at, at the end of the year was extended, and then it was extended again into January, like to February. Well, now FHFA basically announced last week that they're going to extend the foreclosure and eviction moratorium through March the 31st. So right now, basically, you can't be evicted, and if you're in a property with a FHA-backed mortgage, if you're the renter there, and if you actually have an FHA mortgage, you're not going to foreclose upon you and evict you till after the 31st. So that's just, again, the whole point is, it keeps families in their home during the pandemic. That's the whole point of keeping people safe. So we get it. It just sort of, prolongs things. And now FHA also has announced that it will prolong the forbearance plans. And why is this important? Well, what this really boils down to is the fact that, the typical forbearance is a 12-month plan, all right? So you could do them in 2 6-month increments. What they're saying is that, well, maybe this forbearance hasn't worked out. Let me rephrase that. Forbearance helps people, but maybe the economy hasn't worked out as well, and the pandemic and COVID, the whole bit, how it all plays out hasn't got us to where we need borrowers to be, where they can resume their monthly mortgage payments and exit gracefully the forbearance period. So what they're going to do is they're going to allow borrowers to actually extend another 3 months. So if you're in it for 12 months, I'm sure you can go to your FHA, backed mortgage provider and say, I need to get 3 more months. They're willing to do that, which is, I'm kind of 50-50 on this, because once again, we're slowing the market down and we're actually causing longer term problems down the path, which we really are. But in the short term, we're saying to people, okay, you can remain here. So how does this affect? Well, it affects ultimately price points. It affects inventory. It affects us as taxpayers, because you've got FHA-backed loans. That's again, billions and billions of dollars are being covered by us as a taxpayer right now. With the longer these forbearance goes into play, the Biden administration is also pushing Congress to extend this out to September, which I think would be really problematic. So, this is some future videos and discussions as well too. But you can see how government is really starting to get involved in our housing policy now, and I don't think it's always going to end up positive. Now, sure, I'm not knocking people who need this, and if you need it, that's great. But realize that there's more behind the scenes that are going on here, and I think it's not going to help in the long run. But for now, 3 months. The stuff that the president wants is proposed, it's discussed, as nothing is sort of put into play yet. So right now, you could, if you're in forbearance, you could possibly get an extra 3 months after your 12-month plan is over. All right. So let's go to the next slide here. So of course, forbearance at lowest level since April, but further drops in doubt. So again, once we take a look at this, it's like, well, the number of borrowers in forbearance at its lowest level in 10 months, but with conforming borrowers now able to extend their plans, it's uncertain whether that amount will drop further in the near future. So, but also I always want to say that realize when we see drops in forbearance, it's not necessarily that things are good and people are back on their feet and life is rosy. Many times it's because forbearance plans are actually finishing, and therefore if your plan is finished, you've dropped off. All right. So you say your 6-month plan, you've dropped off. Okay, cool. Well, I've dropped off right now, but I still need forbearance, and I have not re-upped for my second 6 months in forbearance. You know what I'm trying to say here? So sometimes these changes are spoken about or talked about as positives, but behind the scenes, and I mention this every time I talk about this, we'll always find that when we see a apparent drop, then we see in a couple weeks afterwards an uptick before that reason. So it's kind of like, okay, we're talking about this again, but we'll see what happens. And what they're saying here is, well, now with even more extensions, that we'll probably see the levels won't drop, because our expectations was about 600,000 people would be dropping out in March, at end of March and April. So we'll see if that 600,000 group stays in this number or it drops out or not, based on what they can do with the plans. So looking at forbearance again a little deeper here, let's look at this here. It's just, how can I put it? It's the same old, right? We'll just look at the numbers here with the next slide. So really, units in forbearance, just under 2.7 million. And you can take a look at the shares. Government-sponsored enterprises, 3.3% of mortgages are in forbearance. Government, which is FHA, VA, 9.2%. Private label, conventional is 5%. And then we've got, overall, it's roughly running around 5% share of the total 53 million mortgages that are out there. Again, representing, over like $500 billion worth of housing, unpaid principal balance, and as I said, just under 2.7 million people facing forbearance. So, like everything, as time goes on, things will start to unwind and we'll see more information. So, the CFPB accuses servicers of misleading borrowers about forbearance. So funny, we're going to hear about that. No surprise to me, because, again, being in the housing industry as long as I have and going through various levels and activities and involvement with the last housing crisis, I saw a lot of this take place, and it's no surprise. So several mortgage servicers gave consumers incomplete and inaccurate information about the CARES Act and forbearance, according to a new Consumer Finance Protection Bureau report. That's what CFPB stands for. Basically, it revealed evidence that some servicers purposely misinterpreted or misconstrued the laws to dissuade borrowers from requesting forbearance. And for example, one servicer erroneously suggested that borrowers had to pay a fee to enroll in forbearance. Another provided incorrect due dates for the borrower's next payment. Some mortgage firms also reportedly sent automated collection notices to borrowers in forbearance, indicating that their accounts were past due and they may incur late fees. So basically, what they're saying here is that we're going to see stuff happen. There's going to be shenanigans going on. Just a few examples that show the types of harm consumers are suffering and meaningful impact that strong oversight could have had on the country's recovery effort. Moving forward, the CFPB will take aggressive action to ensure that regulated companies follow the law and meet their obligations to assist consumers during the COVID-19 pandemic. All right. So, what's happening here is that borrowers are confused. Borrowers are having their, their forbearance put in their credit as missed payments, which is dropping their credit scores. And really, kind of once that's done, there's no reversal. They don't go back in and go, yeah, I'll just take that out and we'll reverse your credit scores. Normally, that doesn't happen, and it just causes more people more pain on different levels. So I look at this basically as, trust no one. All right, that's basically from the X-Files. I don't know if anybody watched the X-Files back in the day. I certainly did. And really, it's the truth is out there, and trust no one. So we know that what's this industry among other industries all based on right now? It's creating narratives, and it's going by narratives. It's making people feel better and not really showing them what the truth is and what's really happening in the housing market. So, and I get it. We don't want to spook people and cause, more chaos and more bad feelings and more, I guess you could say, problems than we need to. But reality is not disclosed, and that's, and I really believe it's just like these are hard numbers. Okay, for groups like Black Knight Financial and other groups that, other and data people like, foreclosure.com, for them to actually go and find all this data and summarize and put it into readable format that we can look at, it's a pretty big task. So there's going to be estimates, guesstimates, samples that say Black Knight Financial, Lord, I'm getting all messed up here with my things. Black Knight Financial will actually, do, like, they're based on sample size and estimates. So we're never going to know the true amount, and it's all guesstimates and stuff. So as I always say, there's more behind the scenes that we're not even aware of. Things are probably worse than being reported, and we're going to deal with that as time goes on. So sorry about the little wordplay there. So that's what's really going on, and so that's kind of the situation. So we basically have forbearance numbers are still kind of there, but we know they're in flux now. Foreclosure numbers are low, and they look great because nothing's happening. That industry or that segment of the marketplace is in suspended animation. So really, what's going on? Well, U.S. home prices passed the 2005 peak level. And what this really article says here is the fact that, they've eclipsed their peak from 2005 following the years leading up to the Great Recession. Now that at the beginning of 2021, we said real estate was entering the year of a massive bubble. So this article was in Bloomberg, and this is basically some discussion from Realtor.com and NAR. So basically saying, prices rose in all 183 metros, sort of measured by the group, and 161 had double-digit growth compared to with just 115 of them in the third quarter, the report notes. So the whole point here is that now we're actually talking about housing bubbles. So as I mentioned, we've got, other groups like Adam and these groups saying, hey, we got these foreclosures and forbearance, talking about, the future will be problematic as this rolls out because of the controlled artificial marketplace right now. Now we actually have the people who are really involved in the real estate industry saying, we're in a massive bubble. We've got issues here. And that's kind of, I don't say the word it's fun. It's interesting because, what we're really doing is we're calling the government out, is what we're actually seeing here, is the fact that, housing is running at such a high pace. What the discussion is that, are we in inflation? Well, the government's trying to keep, the 2% inflation target down and using analysis and statistics to sort of lead us to that's where inflation is. But when we're looking at housing, which is, I guess you could say is far eclipsing that, that's where a lot of the rhetoric is and a lot of the discussion points are, is like, the Fed's ignoring this. My last video was talking about misguided, input into the economy and where things are headed, and where we are right now. It's kind of like, we're seeing massive housing bubble, So anybody out there who disagrees with a housing bubble, again, I'm just some dude who likes real estate. All right. When you got economists, you got lawyers, attorneys, analysts, you've got literally the real estate groups talking about bubbles. Well, guess what? I think we're in a bubble. Now, a bubble is one thing. It's how the bubble, we'll call it, explodes, deflates, whatever it is. That's the real question here, and that's the concern that I think everybody should have right now with respect to what's happening in our real estate marketplace, which is a little bit of a pain right now. So one of the jokes is, it's the new work from home rules, low borrowing costs have helped people along their decision to relocate, but rising prices can be a bad omen for those looking to buy. The obvious decision is for people to leave expensive areas like New York and San Fran in favor of more affordable areas. Surging home prices, as pointed out in January, mean that young Americans can't afford to buy. A record 34% of them now live with their parents. So that's actually growing. So people can't afford to buy homes. They're sticking with mom and dad, which means you don't see new buyers in the market. You don't see upselling and we'll call it transition, people selling bigger homes or relocating to smaller homes or going up in their price points and their home size as well too. Now, Lawrence Young, the chief economist for NAR, concluded the average working family is struggling to contend with home prices that are rising faster than income. This sidelines a consumer from becoming an actual buyer, causing them to miss out on accumulating wealth from home ownership. So really, you got the chief economist for National Association of Realtors basically saying what? This is a problem here, guys. All right. So, if that's not an admission of where things are at, then I don't know what is. If house prices increase 10%, house prices increase, hang on. Lord. Okay, if house prices increase of 10% is not inflation, then what is it? So again, we're going to Bureau of Labor Statistics. We're taking a look at what the Fed's doing. I'm not going to really read this article too much, but I'll put the link into the information section. But the whole point though is that Case-Shiller is showing massive home price increase versus owner's equivalent rent. So you got two indices that are actually diverging. And you take a look at policy confusion. The Federal Reserve is one of the stakeholders and groups that forced to change the measurement of the consumer price index. So that's why we're showing the confusion over inflation. The appropriate measure of inflation has left policymakers adrift. The Fed remained hell-bent on hitting a 2% inflation target with a flawed index and have introduced inflation averaging as a new policy tool. Inflation averaging doesn't eliminate the flaws of price mismeasurement. It compounds them. In other words, a donkey indicator is still a donkey after averaging. So, that goes back to home price appreciation's up, but it's far beyond where things should be. It's inflation is what it boils down to. So and as the previous slide, people can't buy houses. They're forcing, if they can, they're going up on price points and taking more risk. Low mortgage rates are great, but we know they're putting less money down and more risk in the market where it's at today. So, core CPI versus home prices. So when we take a look at this, these are where analysts are raising concerns. The fact of the market that, home prices exponentially going forward higher and, core consumer price index actually dropping. So it's not rising at the same rate. It's actually going the other way. And that's where we see a big divergence. And that's why analysts and economists are saying we have problems in this industry. So when will this ride end? So it's silly, guys. Well, we were looking at 600,000 seriously delinquent borrowers that would roll off forbearance in March 31st. We'll see if that actually happens. There still is a segment of people that aren't covered by any forbearance plan that are going to work their way through the foreclosure process, and they'll become available as well too. We're looking at tons and tons of properties here that I think are underrepresented. We know the single-family rentals has become an asset class, and operators are looking for land, build to rent, just buy to rent, whatever it is. Lots of dry powder looking to purchase. We know that Black Knight's looking at this many total properties in some form of delinquency and loan process. I do believe it's underrepresented. We'll see how that works out. These guys talking about short sales, their pre-foreclosure sales are poised to become more dominant share of the stressed market as the year goes on, which I agree. And that's what our focus is going to be here where I'm at and what I'm doing. So it's something you may want to think of yourself here. 1% of all on-market property sales fall into the distressed property category. REO sales and short sales. No one's doing short sales. How do we know this? It's the 1% rule. It's actually less than 1% rule. Foreclosure filings are quietly increasing. more properties are scheduled for foreclosure auction, back at that 1% rule. Not much happening, but we're seeing that increasing. Now, stop flooding the housing market. Work with what we are given. Why is this important? Because if you want to make money in housing, you know what? It's all relative to the timing. So if I get a distressed property today, I'm going to buy it for X and sell it for Y, I'm going to make Z, all right? So that's going to be relative to 6 months down the road, a year down the road. I'm going to buy it for X, sell it for Y, and make Z. So I'm going to buy it for less, I'm still going to sell it for less, I'm still going to make Z. You see what I'm saying? So you don't have to wait for these material discounts to get involved. If you're working with distressed housing, there's always going to be discounts there, and it's going to work for you. So I say ride the wave, select a local market, get control of a distressed property, earn money, or get a better price home to live in. Now, I'm going to give you a little look here. So this basically is the most recent data I have for where I'm in the Tampa area. I'm in Hillsborough County, Florida, okay? So this is just single-family homes. This is not representative of the entire, condos, land, commercial, mobile, manufactured, villas, whatever. This, income properties. This is just single-family homes, right? So basically, if you take a look at what happened in single-family homes in December, I'm going to zero in on this graph here. So take a look. So the median price point is, look at the median price point for this past December was almost $300,000, okay? Now look at the closed sales, almost 2,000 closed sales. The amount of foreclosure REO sales that closed was only 11, okay? So that makes nothing, makes no dent to the marketplace here. And look at the median sales price of a closure or REO that was on market. It was about what? I'm looking at, 45 grand, basically, hang on a sec here, about 40 grand, almost 45 grand less, all right, than the traditional price point here of medium sales price for traditional sale. But look at short sales, there's even less short sales, and look at their median price, 225. So we're almost 75 grand less than the median price. So there are discounts there, and so what does this slide prove? It proves that short sales are less than half a 0.5% of the market. And REOs are less than 0.5% or 0.5% of the market as well too. You're looking at, just for example here, that's 25% discount over retail on the median sales price. And I can tell you that when you look at this, when you go, well, 25% maybe is not as much discount that I would like. Well, first of all, it's pretty good as to where our market is right now. So I wouldn't complain about a 25% discount when you buy a property. Now, but here's the thing. These are what I call retail short sales. So I can tell you that, and I'm making a pretty blanket, ubiquitous statement here, but based on my experience, a lot of the listing agents aren't working the deals where they could get these prices even lower. So this is just median versus median on retail short sales. I can tell you that we can get better discounts than that when we put it in the right process, the right system, and do the right thing. So this is where the opportunity is for more deals down the road at better price deals. The numbers speak for themselves. People say, what's it worth for me? Well, we know that the average foreclosure discount's about 35 to 36%. That's auction pricing, etc., versus your retail price. That's from the auction people that actually will go and talk about that and do the statistics. But this is just my local county here, looking at closed sales that happened in December. And you can see that there's certainly material numbers there, and I know that we can push that number down if we're doing things the right way with the right system to get us better discounts on these properties. So I just want to let you guys see that so you know it's there. How do you get involved? Well, guess what? I talked about doing a new program here called Zombie Foreclosure Flip. I do have my short sale product you probably want to talk about. I'll tell you all about where everything's going if you just connect with me, Randy@luxuryshortsales.com. Drop me a line, we'll connect. Once again, thanks for the views, likes, comments. Please, if you're not already subscribe and help my channel grow. Remember, if you want to look at foreclosure data, gethousingdata.com takes you right to the foreclosure.com webpage. Free 7-day trial, very inexpensive to jump on the data service right there. Check it out and see what's going on in your local market. Put it this way, it'll be the best $40 you'll ever spend to see what's happening in your local market. All right, guys, thanks very much. Look forward to speaking with you later on this week.